Silver investors, on your screen it looks like silver just broke. Brutal red candles, ugly drawdowns, and a lot of people screaming that the move is over. But step back 1 year and the same chart shows a metal that's still roughly 140% higher than where it was this time last year. A violent correction sitting inside one of the biggest 12-month repricings of this entire cycle. I'm OG John AG, and in this video we're going to unpack how silver can be down 15-25% from recent highs and still be up more than 100% year on year. Why that combination usually means leverage just got cleaned out, not that the story is dead, and what this all means if you're trading paper or quietly stacking metal in 2026. By the end, you'll know whether this is the end of the move or just the part of the journey where weak hands hand their coins to stronger ones. Segment 1, the shocking year-on-year math. Let's start with simple numbers, not headlines. Roughly 1 year ago, silver was trading down in the low 30s per ounce, call it around 32 USD as a ballpark. Today, even after the recent sell-off, spot is in the mid-70s per ounce. Do the math. Move from 32 to 77 is a gain of about $45. 45 divided by 32 is around 1.4. That's 140% higher than last year. At the same time, from the local peak, if price ran up into the 90s or even triple digits and then dropped back into the mid-70s, you're looking at a 15 to 25% correction off the highs. So two things are true at once. On a 1 month or 3 month chart, silver looks like it got punched in the face. On a 1 year chart, silver still looks like a rocket. If you only stare at the last 3 candles, you see pain. If you zoom out 12 months, you see one of the strongest moves in years that just hit a turbulence pocket. Segment 2, why the recent drop felt like the end. If the bigger picture is so strong, why did the last move feel like a catastrophe? Because the path wasn't smooth. Over the last stretch we had an aggressive upside run as inflation fears, rate cut bets, and safe haven demand all converged. Then a sequence of sharp sell-offs where daily drops of 10 to 12% were reported, especially early February when silver plunged double digits after a short-lived rebound. Moves like that aren't normal repositioning. They are classic signatures of crowded long positioning, high leverage, systematic and algorithmic strategies all watching the same levels and risk limits. When those levels break, stops trigger. Margin calls kick in. Models force desks to sell because the rules say so, not because the long-term silver thesis vanished overnight. Emotionally, a 10 to 12% intraday dump feels like the market is rejecting the entire story. In reality, it often means the trade got too crowded, too fast, and the market is doing risk control the hard way. Segment 3, what a 140% YoY move really signals a more than double in 12 months isn't random noise. It usually means at least 3 deeper things are going on. Macro stress and policy risk are real. Markets don't double a major monetary industrial metal unless central bank policy is uncertain, debt and deficit worries are mounting, inflation and currency debasement fears are alive, even if official numbers look tame. Research from major banks this year asks exactly this. Will silver in 2026 trade as a hedge against sticky inflation and slowing growth, or as a high beta risk asset? A 140% move says the hedge side has been very alive. Speculative and trend-following flows piled on top. Once silver started breaking out of old ranges, it became a target for trend-following CTAs and systematic funds. Short-term traders chasing momentum, late retail money reacting to headlines, not building positions quietly. Analysis of silver's technical map for 2026 note how key breakouts pulled in speculative money and pushed price to the upper end of projected ranges. The system is now hypersensitive to shocks, with price much higher and day-to-day swings bigger. The same percentage move translates into a much larger dollar gain or loss. Risk models tighten, risk managers get nervous, and even small changes in Fed cut expectations, dollar strength, geopolitical headlines can flip the market from chase long to cut exposure now. That's why you're seeing explosive candles on both sides. Segment 4, the role of the Fed, CPI, and the dollar short-term silver trades on 3 big macro dials, the Fed's path for interest rates, inflation data, CPI, PCE, the strength of the US dollar. Recently, markets have dialed back the number and speed of expected Fed cuts in 2026 compared to the most aggressive hopes. The dollar has seen episodes of renewed strength as growth data surprised and risk sentiment wobbled. That combination is a headwind for metals. Higher or stickier rates keep real yields elevated. A stronger dollar makes silver more expensive for non-US buyers. So what happens after a big rally? The same macro factors that pushed silver up, rate cut bets, weaker dollar phases, risk hedging, can reverse temporarily. When they do, a lot of those leveraged longs and momentum trades crowding in at the top have to exit fast. That's how you get a situation where the reasons silver moved up 140% aren't fully gone, but the positioning on top of those reasons becomes unstable and has to clear. Segment 5. Under the hood, demand, supply, and the 2026 outlook zoom out from the trading desk and look at the industrial and investment backdrop the big research houses are talking about for 2026. On the demand side, silver is heavily used in electronics, solar panels, EVs, and other green energy applications. The Silver Institute and large banks project that global silver demand in 2026 should stay robust, with investment demand and key industrial uses offsetting any weakness in other sectors. Articles looking at silver's 2026 prospects highlight it as a key beneficiary if the energy transition and infrastructure spending stay on track. On the supply side, mine production is expected to grow only modestly after years of underinvestment. Recycling adds some supply, but not enough to overwhelm demand if industrial usage and investor interest remain strong. Some recent commentary explicitly asks whether silver is a hidden opportunity or a dangerous bull trap for 2026 traders, precisely because fundamentals look supportive while price action is extremely volatile. The takeaway, the underlying industrial plus investment case hasn't been canceled by this correction. The physical market still has to balance real flows, regardless of how brutal the last few candles looked. Segment 6. Why boom and bust moves are normal for silver. Silver has always been a drama queen. Its history is full of long, boring periods of range-bound trading, followed by explosive up moves, then sudden, violent corrections that wipe out late leveraged buyers. Historical analysis of silver as an inflation hedge shows, over multi-decade windows, silver has protected purchasing power well, especially in inflationary bursts. But the journey was much more volatile than gold, bigger overshoots, deeper drawdowns. More recent forecasts describe silver after multi-year surges as entering a high-risk, high-reward band. Upside potential remains if inflation, energy transition, and currency worries persist. But position-clearing drops of 20–30% can happen without killing the bull case. In other words, what feels abnormal emotionally is fully normal structurally for this metal. Segment 7. Traders versus long-term holders. Different games. You and I need to be brutally clear. Traders and stackers are playing two completely different games with the same metal. If you're trading, silver at 75 after 90–100 is a live fire exercise, not a safe trade. You must respect volatility. Expect 3–5% daily moves, 10% days in stress, levels, recent highs, lows, moving averages, prior support, and resistance. Risk. Position sizing and stop-loss discipline so one bad day doesn't nuke your account. Analysts mapping silver's technicals into 2026 highlight how important it is to watch big ranges, often citing zones like the low 70s as key support and mid-80s to 90s as resistance bands. You can't treat that as a sleepy bond. It trades more like a tech stock tied to macro. If you're a long-term holder, your edge isn't perfect timing. It's persistence and sizing. A 15–25% correction after a 140% year doesn't automatically break your thesis. What matters is, do you still believe debt and deficits will worsen over this decade? Do you still think currency debasement and inflation risk are here to stay, even if they come in waves? Do you still see silver's industrial role expanding with EVs, solar, and infrastructure? If those answers are yes, then corrections are what you budget for emotionally when you decide to hold silver, not evidence you were crazy to own it. Segment 8. How 141% up plus sharp drawdown can be an opportunity. So how do you combine all this into a sane framework? Except that the last 12 months were extraordinary. A 140% move is not a normal year. It compresses years of repricing into one. That kind of move almost always gets followed by a digestion phase, sideways chop and sharp pullbacks while the market rebases. See the correction as a positioning flush, not a verdict. Evidence from price action and news flow points to stops and forced selling after overextended runs, rather than a single fundamental event that destroyed silver's purpose. Similar flash crash reports in January mentioned profit-taking and overcrowded longs as key triggers. Use clear rules for adding or trimming traders might look for confirmation. Reclaiming broken levels, improving momentum, softer Fed rate language, or a weaker dollar before sizing up again. Long-term holders might simply decide a target allocation, for example, X% of net worth in metals, and use corrections to rebalance toward that number instead of chasing blow-off tops. Separate price from purpose. The purpose of silver in a portfolio, hedge against monetary risk, plus exposure to key industrial growth trends, hasn't changed because price is temporarily unfriendly. The price of silver is what the most emotional and levered player is willing to pay or accept today. Those are two different realities. That combination, structurally strong story plus violently cleaned up positioning, is exactly where some of the best long-term entries historically show up. Segment 9, the bottom line. Here's the honest summary if you're still watching this with a position or a plan. Silver is roughly 140% higher than it was 1 year ago, even after this correction. The recent drop looks brutal on a short-term chart because it hit a market that was overextended and overleveraged. The macro and physical pillars, debt, inflation risk, central bank hard asset demand, EV, solar, tech usage, and constrained supply growth are still in place for 2026. That doesn't guarantee straight line upside from here, but it does mean you should be very careful about confusing a nasty cleanup after a huge run with the end of the silver story. You've been watching John AG here, and I'm OG John AG. If this helped you see the difference between a scary month and a powerful year, hit like so this kind of context doesn't get buried under clickbait. Subscribe and turn on all notifications because this isn't the last violent move we'll see in silver for 2026, and next time I want you positioned with a framework, not just a feeling.